12% or $9 premium right now in Shanghai on silver, or an $85 premium in gold. And here we are at 75. I mean, that's wildly bullish, right? You can see that gold and silver are moving east. We know that. If you're a JP Morgan trader, you take 10 million ounces, you sell it at a $10 premium, deliver it through what's called exchange for physical, in essence, where you deliver it to Brinks, Hong Kong. You just made $100 million. A million ounces of gold at an $85 premium, you just made $85 million. And the West looks at gold as a trade and the East looks at gold as a settlement asset. The numbers coming out of London are a lie. Just like the information coming out of the Bureau of Labor Statistics, just like the crap we see on COMEX. The Western institutions, which are built on trust, are being exposed as being not trustworthy. Silver withdrawals since the start of the year, 158 million ounces through April. Now, 15 million pounds. Who's taking all of this metal and where is it going? Some people are exporting and some are using this ability to stand for delivery through what's called exchange for physical.
Silver futures have just cracked below 75 an ounce. They've been down in this territory before, but they were up at like 89, like a week ago, and then lost it all. Gold is 4,400-ish. So it's kind of on this sort of like slow, steady fade. And I think folks are probably naturally starting to worry, whoa, this stuff's not regaining momentum and slowly trending down. Is it going to find some sort of breaking point at some point down here? Not saying that's what you think, but I'm just curious. What would you say to people who have those concerns?
I'd say watch your video with Michael Oliver
that I
watched a week ago or so, and it will renew your faith in all of this. I mean, look, I think first and foremost that there is, and there has been, and I think that's not what this is about, but there has been selling physical to capture profit. But you look at that from a pragmatic standpoint, and you say, yes, there's this choppiness. It's trading with great volatility within a range, right? It's been that way, and that's been the way that it's always worked for the last several years. It goes way up, trades sideways, choppy within a range, butts up against resistance, falls through it, but comes back, chops, freaks everyone out because of the sawtooth nature. But if you put that picture on the wall and go to the back of the room, you'll see a straight line. You won't notice that.
Markets are celebrating cooling inflation, while silver just erased nearly 15 points in days, and the divergence rarely ends quietly for unprepared investors. According to Andy Schectman, the violent swings are masking a much larger trend of steady, upward repricing beneath the noise. Retail sees instability because they watch daily candles, while institutions focus on physical accumulation ranges over multi-year cycles. The real danger is not volatility itself, but investors getting psychologically shaken out before the structural move fully matures. Next, Andy Schectman reveals why physical selling pressure may actually confirm stronger long-term demand underneath the paper market chaos.
You know, the maddening volatility, and then it goes up again and catches everyone by surprise, and then chops, corrects, then chops. But it's higher highs and higher lows. Look, I mean, silver was $35 an ounce last year, Adam, and here we are at 75. I mean, that's wildly bullish, right? And in the same thing, I mean, look, this to me is a classic bull market sign. And when you talk about early in a major move, first of all, you get the older holders who sell into strength, and they're relieved to finally take profits. They can't handle the volatility. They have the same tenor or belief structure that you just mentioned, and they're getting disillusioned. But if the price keeps steady and even rising, if you go back and look at it from a longer perspective, it is rising and with great volatility, not the way that we would all like, but it tells you that demand is far deeper than the visible retail market. I don't know. To me, that means physical is being transferred from price-sensitive weak holders to the strong holders. And I think you could say the same exact thing about what's happening in China. Now, you look at the amount of gold and silver that is going into China, it's off the charts. And I think that you could, highlight that by simply saying in the West, I'm not talking the way the government looks at this, right? I'm talking the way that the traders look at this with a 12% or $9 premium right now in Shanghai on silver, or an $85 premium in gold.
Silver doubled from $35 to $75, yet many investors feel more fear now than when prices were lower. And that psychological disconnect is exactly how long-term wealth transfers happen. Andy Schectman notes that stronger hands appear to be absorbing supply, while frustrated retail holders exit during volatility spikes. A persistent Shanghai premium above Western pricing signals physical demand that paper markets still refuse to acknowledge honestly. Savers relying solely on traditional portfolios may not realize how aggressively global buyers are positioning for monetary instability beneath the surface. Next, Andy Schectman exposes why China keeps paying massive premiums for physical metal, while Western traders still dismiss the signal.
You know, look at the amount of gold and silver they've imported. It's unbelievable. And you can see that gold and silver are moving east. We know that.
And Andy, I'm sorry to interrupt, but when you talk about those premiums, are those premiums to spot or are those premiums to the U.S. price?
They're premiums to the Western price. And we've talked about this before. I remember early in the game, you and I talked about this. We said, well, what about the VAT tax? And I dug. And the VAT tax is paid by the recipient, not the sender, not the seller, when it leaves the Shanghai Metals Exchange. And so you have, imagine if you're a JP Morgan trader and you take 10 million ounces, you sell it at a $10 premium, deliver it through what's called exchange for physical, in essence, where you deliver it to Brinks, Hong Kong, which is a COMEX contract. It's picked up by truck and driven to Shanghai at a $10 premium on 10 million ounces. You just made $100 million. Or, wow. You know, a million ounces of gold at an $85 premium, you just made $85 million. And that is what they are doing.
Yeah, let me underscore that for folks just to make sure they really get it. So we hear about this Chinese premium and then why do I care? I'm here in the West, right? I'm good for me. I'm buying a little bit less. But what's happening is that is acting as a vacuum that is sucking physical from west to east. Why? Well, because if you're a Western seller, why would you sell it in the West?
JP Morgan traders can reportedly earn tens of millions simply by moving metal from Western exchanges into Asia. Yet mainstream financial media barely mentions the arbitrage. What Andy Schectman is highlighting is not just higher pricing in Shanghai, but a systemic incentive pulling physical supply out of Western vaults permanently. When premiums persist this long, it suggests institutional buyers are willing to pay almost anything for actual delivery, not paper exposure. Investors still treating gold and silver as short-term trades may be missing the global repositioning already underway. Next, Andy Schectman reveals why these Eastern premiums may expose a deeper breakdown in Western price discovery itself.
To your point is, go sell it in Hong Kong, right? Get paid whatever that was, 12% more or whatever, for the exact same thing you could sell to a Western buyer. You're just selling it for 12% more in China. And then they're hoovering it in there. And so if you care in the long run about, well, if we think gold is an essential asset, where is it going? Well, if it's all going into the East, that's not in our long-term interests.
No, it's not. And the West looks at gold as a trade and the East looks at gold as a settlement asset. And now you're seeing it happen in the Middle East too, which looks at gold as sovereignty after seeing what's happening around the globe. And you can see it with the selling of treasuries. Saudi Arabia has imported roughly 1 million ounces of gold from Switzerland alone this year. And these numbers are fugazi, and pardon my French. You know, Goldman Sachs just came out and said, you know, the numbers that we told you at the end of 2025 about what we expected the central banks to be buying, they came back at the end of 2025, made a big deal that, you know, we're going to revise things maybe a little bit more neutral because we think that the central bank demand is waning, right? Well, they just came out and revised those estimates massively upwards by an order of magnitude, and yet doesn't get picked up by the mainstream. But, you know, and the reason, this goes back to the lack of trust, right? We've talked about the 4 glitches we've seen on COMEX, 2 to the up, 2 to the down.
Goldman Sachs quietly reversed its central bank demand projections upward after previously signaling weakening appetite for gold, and almost nobody in mainstream finance acknowledged the reversal. Andy Schectman's argument suggests the real story is not price volatility, but collapsing trust in Western financial plumbing and treasury-based settlement systems. While retail investors are distracted by short-term pullbacks, sovereign players across the Middle East and Asia continue accumulating hard assets tied to monetary sovereignty. That shift directly threatens portfolios built entirely around dollar-denominated confidence remaining intact forever. Next, Andy Schectman unravels why repeated COMEX glitches, maybe exposing a credibility crisis institutions cannot publicly admit.
When it's cascading down, the circuit breakers don't work. When it's going up fast and furious, it shuts down at 11 o'clock at night on Thanksgiving night because supposedly the servers overheat. Of the 1,000 commodities traded, just the gold servers on Thanksgiving night overheated. Okay, well, bottom line is you got the UK coming out and reporting metal that has been sold, leaving the vaults not matching the export numbers. And so Goldman says, there's this huge discrepancy. It must be the central banks because they're not telling us the truth. People are getting gold that it's not being reported. So they came out and late last year and said, well, we're revising our estimates to 29 tons a month that the central banks will be buying. Then early this year, they said, well, okay, maybe it's about 50 tons a month. And now they just came out and said their new 2026 projection is, well, because of this discrepancy, that they're actually buying 60 tons a month. So they've doubled what they said. And, it's happening. And that's largely because the numbers coming out of London are a lie. Just like the information coming out of the Bureau of Labor Statistics, just like the crap we see on COMEX, the Western institutions which are built on trust are being exposed as being not trustworthy. And I think that's why you're beginning to see this hoovering. Now, you and I have been talking about this arbitrage in China for a long time. And anyone who's been around finance long enough would know that when you see arbitrage, the big boys and girls in New York would say, bang, throw everything at it. And it would be over in a matter of days, right?
The timing of repeated COMEX disruptions during upward gold moves is becoming harder to dismiss as coincidence rather than market control. This is where Andy Schectman's thesis shifts from simple supply-demand analysis into institutional credibility risk across the entire Western pricing system. Goldman Sachs doubling central bank purchase estimates within months suggest far more gold is moving quietly than official reporting admits. For long-term savers, the danger is trusting headline narratives while sovereign accumulation accelerates behind opaque reporting channels. Next, Andy Schectman reveals why a year-long arbitrage opportunity should not exist unless the physical market is structurally tighter than reported.
Because they would capitalize on that arbitrage until it normalizes. It hasn't normalized in over a year. Why? Because they know that deep down these traders are motivated by greed and they will siphon every single ounce that is privately held and send it over there and it will never come back. And I think it's really
they're using the greed of capitalism against it here. Sort of
exactly
a
right.
Yeah. Or a judo move, sorry.
Yeah.
All right. So it sounds like you've said that the volume of imports going into China, which has risen to what I think you've said in the past, sort of unprecedented levels that you've seen in your career. Sounds like it's remaining at those unprecedented levels. How about with deliveries from COMEX, physical deliveries from COMEX? Those also had risen, here in the West, those had also risen to unprecedented levels. And the last time we talked, you had said, yeah, they're still maintaining. Are they, or are they starting to abate at all?
Yeah, through May, through the 22nd. So that would have been, I guess, Friday. We saw 6,633 gold contracts. So there's still a few days left. That's 663,000 ounces. Multiply that times $4,500, a couple $1 billion. And so far, silver, 5,704 contracts. That's 28,520,000 ounces. Again, times $75, a couple $1 billion. Silver withdrawals since the start of the year, withdrawals, meaning driving away, 158 million ounces through April. Now, 158 million ounces is roughly 15 million pounds-ish or more, 16 million pounds. So who's taking all of this metal and where is it going are the questions. So
a year-long arbitrage opportunity in precious metals should not exist in a supposedly efficient global market unless somebody desperately wants physical supply regardless of price. As Andy Schectman points out here, COMEX deliveries and silver withdrawals remain historically elevated even after massive price volatility scared retail traders out. Institutions are not behaving like they expect deflation or monetary stability ahead. They are behaving like hard assets are becoming strategically scarce. For wealth preservation investors, the real signal is not price action, but the relentless removal of physical inventory from the system. Next, Andy Schectman exposes why official trade numbers may be disguising where global metal flows are actually going.
Yes, they are. Now, there's also a thing that I would like to discuss real quick, and that's talking about this theory about export numbers, that supposedly we've been exporting all of this gold. And some of it is not true. I mean, it is, because you can see the traders sending all of their metal that is not nailed down to China. There's also France repatriating all their gold. Well, that would show as an export, right? And it doesn't, there's no distinction. So you would see all of that metal being sent over. You would see the metal that's being brought from the Venezuelan mines to, I think the company's called like Trafigura here in the United States, something to that degree, who then export it to Switzerland to have it refined. Not all of it's going elsewhere. Some of it comes back here. But my point is the exchange for physical, where players around the world have COMEX contracts, exchange for physical, send it to Hong Kong or send it to London and then take possession. There are a lot of things happening that show up on the trade numbers as being a trade surplus, but they're really not. They are players bringing their stuff home. They are exports to refineries in Switzerland. Some of it might go elsewhere. Some of it may not. It's mining companies sending directly. So there's all of these numbers that make it look as though we'd be, the last 2-3 months, we've had these huge export numbers of metal. I would argue that it's less than candid in terms of what it truly means. And the imports that we've seen are massive. And you can look at it the other way and just simply say, it's very bullish for
export data is suddenly being treated like proof that the West still controls the gold market, yet much of that metal may simply be moving through hidden settlement channels. Andy Schectman notes that exchange for physical transactions, refinery transfers, and sovereign repatriation flows can all distort trade statistics while masking true ownership changes. That matters because investors relying on headline export figures may completely misunderstand how aggressively countries and institutions are reclaiming physical assets behind the scenes. The deeper story is trust erosion inside the global settlement system itself. Next, Andy Schectman reveals why soaring imports may signal that physical metal is becoming strategically irreplaceable.
The final price of gold and silver, because it proves that the physical price is worth far more than the paper price in the West, and enough to take possession of it speaks volumes.
Okay, I get all that. You've said something that caught my attention, which is you said the imports have really surged. So even though the West is sending still a whole bunch to China, is the US importing more than it used to?
Historically, way more, but over the last few months, the export numbers are larger than the import numbers. Now, the question is...
You're saying, though, those aren't really...
Well, yes, because there's no distinction. If it's an exchange for physical, it looks like we exported metal. If we're sending metal for refining in Switzerland, it looks like we're exporting metal. And so there is some of it is real, but some of it is not as it appears. So I would think that this would be a short-term blip in terms of major exports. And at some point, there's just not enough metal to continue to send to fulfill that arbitrage. So I think it's a short-term deal. But yes, we're still importing. Every single month, we're importing a tremendous amount. And so some players are importing and some people are exporting, and some are using this ability to stand for delivery through what's called exchange for physical, where they take a COMEX contract and either deliver it directly to Hong Kong or to London and then take delivery around the globe from there to their advantage. It's part of the rules until otherwise noted. So it's not like the US government is selling all of their metal.
Paper pricing still says precious metals are functioning normally, yet global buyers keep paying extra just to secure physical delivery immediately. What Andy Schectman is highlighting is that import and export data may be disguising a tightening physical market underneath a highly leveraged paper system. Once arbitrage flows exhaust available supply, pricing pressure can reprice violently because settlement confidence disappears faster than liquidity. Investors focused only on ETFs or futures exposure may discover too late that ownership claims and actual deliverable inventory are not the same thing. Next, Andy Schectman points out the sovereign level behavior suggesting governments may already view silver as strategically critical.
In fact, I don't even think it is the government. I think it's private players trading private metal to become very wealthy.
Okay. So let me ask you this, Andy. You noted for us a couple months ago when the US government added silver to the list of essential minerals, right? Has there been any notable change since then? And I guess where I'm going with this is, okay, there's this wave of metal going from west to east. Do you see the U.S. as waking up and actually taking real measures, or maybe they will in the near future, to start slamming that window shut and saying, hey, look, this is an essential mineral. Like, we've got to, A, keep this thing here. We don't want it to go out of the country anymore. And then B, we want to go out and find more of this stuff, whether it's domestic production or international production, but get more of this into our borders.
I think they have. I mean, you ask yourself, who's taken physical delivery out of COMEX to the tune of, what I say, what did I say? The number?
I think you said like 15 million
pounds, right?
Pounds, yeah.
Yeah. Well, and
so who? Yeah, we've talked about this. Who could really be doing that?
Right.
Probably a sovereign player, probably the U.S. in many parts. But again, why are we still letting stuff leave the country then?
Well, because some of it doesn't belong to us, and it's, you know, some of it, I think it's a mystery why they allow it. I think if they were to clamp down on it, it would certainly. Look, part of what makes a exchange real is the ability to stand for delivery.
Washington labels silver an essential mineral, yet physical metal continues flowing overseas through the very exchanges regulators claim are functioning normally. Andy Schectman's argument suggests sovereign accumulation may already be happening quietly behind the scenes while public policy remains deliberately ambiguous. If governments begin restricting exports or prioritizing domestic stockpiles, markets could suddenly realize silver is no longer treated as a commodity but as a strategic monetary resource. That shift would hit retirees and traditional savers hardest because most portfolios remain positioned for perpetual financial stability. Next, Andy Schectman unravels why stopping physical delivery could instantly expose the COMEX system's biggest vulnerability.
You take that away and the COMEX dies overnight. Because, you know, someone said to me, well, could there be two prices? By the way, the exchange in India and Mumbai is actually, their premiums right now have jumped above Shanghai. The premiums in India right now are, it's $10.35 or 13.5% premium. So send your silver to India, you'll get even more than to China. They're doing the same playbook. But, you know, someone said, couldn't there just be two prices, the West and the East? And I said, well, sure, there could be. But if that happens, then the COMEX is dead because people will buy where it's priced fairly. And if you do not allow it to leave the country, then you have just, in essence, signed the death warrant for the COMEX, because an exchange that doesn't allow for delivery is not an exchange. It's something else. And this is the one thing that is kind of the hidden Achilles heel of the system. If you stop allowing those exchange for physicals, you stop allowing metal leave the country, then you will find price setting like that across the globe leave COMEX, and all of the participants across the globe will never trade with us again. Why would they? They would go to the exchanges that are opening up around the globe. And this is like the Singapore exchange that in December started selling kilo gold bars deliverable right away, not rehypothecated and financialized. They just came out last week with the 1,000 ounce silver contract, deliverable, not rehypothecated and financialized. This is what the global south buys, kilo gold bars. And instead of buying a 5,000 ounce contract that is sold 50 times over, you buy one 1,000 ounce contract that you can take possession of like that. You have to. Same thing in Shanghai, same thing in Dubai, same thing in Mumbai, same thing in St. Petersburg, same thing in Moscow, and on and on. All of these exchanges are the arteries of the new BRICS system.
India's silver premium just surpassed Shanghai's. And historically, these kinds of settlement shifts happen before larger monetary realignments become obvious to the public. This is where Andy Schectman's thesis shifts from metal pricing into a direct challenge against Western exchange dominance itself. New exchanges across Singapore, Dubai, Mumbai, and Moscow are prioritizing immediate physical delivery, while COMEX still depends heavily on leveraged paper exposure. If global participants lose faith in Western settlement integrity, portfolio diversification alone may not protect purchasing power during the transition.